Hello and welcome to Erik Penser Bank. My name is Jonas Thulin, I'm Head of Asset Management, and I will try to, as brief as possible, walk through our house view and our predictions for the markets. And I can make an executive summary to begin with and stating that yes, we're still maximum overweight equities, and I will try to drive why. We're very fortunate to still maintain our green traffic light, i.e. 90% of our mandates over $50 million are beating the benchmarks, both long, short and short term. And that's of course a good position to start talking about a house view from. But obviously we have several updates now given the fact that we have seen a little bit of repricing in terms of the Fed fund futures, in terms of anticipation of high Fed funds pressures, and how have we coped with that. And I will show you a case that we made, which is not perhaps consensus trade. As a hint, we have bought a very edgy, high-tech strategy, and I will derive why we've done that. Now, in terms of the outlook for 2023, this is unchanged. What we've changed now is the recession risk probabilities or risk scenarios. Nothing new here. I mean, the really interesting thing here was that the market thought was a 90% risk of European and German recession and 65 for the US. That was an interesting case to talk about at the end of last year when we went fully against this. But that said, it is a little bit interesting to see there's still some money to be made here. And in this graph, I borrow from Macrobon, and I think it's a great graph they made in terms of just illustrating that this idea of, my interpretation of this is the idea of the deglobalization or globalization. It's not new. This is annual data. It's really lagging our actual time. Look, we only have 2019 data on this. But the idea that globalization peaked in the financial crisis is quite rational. And since then, we have actually lived with a trend line which shows that the aggregate amount of imports and exports is decreasing as a percentage of GDP, i.e. we become more and more domestic driven. Which also means that this idea that the deglobalization will mean inflation is a little bit hard to prove. If anything, if you look at the big economies out there, for example China, they are exporting deflation for the time being, and I will show you that more in detail. So the forecasts are unchanged, the strategic allocation is unchanged, we keep maximum overweight to equities. One idea that we want to throw in and remind people of is that we are in the third year of the US presidential cycle, and if anything, this is supposed to be the best year of US presidential cycles, and it troughed at the same time as the statistical mean from 1920s, and it's not surprising because that's the midterms. And then we move on upwards, which would be great fun if we do this year as well. The future of political risk is actually for it to be coming down. We can't really see anything brand new spanking happening here. Obviously we look at US debt situation, but so far the political conflict and risk index for the US is very well maintained. And we'll see if that keeps on developing that way. On the big picture, the macro context, we still see that we're moving from a high inflation, low growth to a normal inflation and low growth. There is a difference for the S&P 500 of going on annual on average since 1970s of minus 10% to deliver plus 15%. It's a delta of 25%. We think that that is still the main context, and that has been a house view since second half of last year. And so far we think the market has rewarded this view and forecast, and we'll see if we can stick to it. But so far this is, I think, a big contextual transition that we're experiencing. So when do we know when to underweight equities? Well, obviously to underweight equities, it's a huge call because it's quite costly to make. And if you look at the blue bar here, it's actually when you statistically have made more money to underweight. You go from a 60-40 portfolio to a 40-60 portfolio just to have something to do the math on. And you can see when you break the standard deviation is where you really should underweight equities. And you had some instances in 15-16 when China withdrew liquidity. You have 18-19 with Donald Trump's tax package there that meant that you had to pay for leverage positions on hedge funds, etc., etc. It disappeared as quickly as it came because it was more of a calendar effect. And then obviously you had the pandemic. And in this instance, we would argue that it was more beneficial given the fact that you lost equal amount of money on global fixed incomes, on global equities, that you are better off working with FX exposures and short positions and cash positions rather than jumping into a 40-60 portfolio. And then we got rid of those hedges in June last year. But it's quite interesting now, if you look at the macro risk, you clearly can see that there's no signs to advocate for a downshift in equity allocation as of now. So it's almost like we would like to throw out there a little bit of a gauntlet and see that if you're underweight equities, I mean, why? Given the fact that so far since October that's been a loss. But it's quite interesting to navigate this, and especially when you look at in terms of what's driving the market, because obviously with the pivot that happened in October, and then that was sort of when the market was exhausted in terms of Fed policy hikes. You can see the 60-40 portfolio then moving on upwards. You can see the driving factors here. You can translate the driving factors into R squares. R squares. You can call them R2s. And you can see the macros driving it, and as of late, rates have been picking up. Given the fact that we've been pushing up Fed fund futures, we're pushing up in the sense that we see higher Fed fund rates, and that has pushed down the equities a bit. So rates have been pushing up, but importantly, we're still trading more on growth, and that's quite interesting. And I think that's why institutions are still buying equities, whilst retailers are doing something else, i.e. selling equities. It's quite interesting. But the driving factors are still the same: Fed, growth, and inflation. And we take a look at those now in rapid speed. Well, maybe not rapid, but with some speed. And you can see that all the inflation matrices that we've been looking at since June of 2022, when they made a peak, they are still making the same signal, i.e. the concern about inflation leading to high policy rates, but not worsen equity sentiment or risk in the financial market, means that we hold tight and we will exploit that price momentum to take the opposite view. Aggressive, perhaps opportunistic, absolutely, but that's also our job, and I'll explain exactly what we've done. The arithmetic base effects are still the same, i.e. it's very hard now to change the trajectory of inflation. We all know that, which is why I think the inflation is a bit too much of a concern. The dollar thing peaked back in June. It will just come in lower and lower. If you look at the next print, it will come in even lower than the last one. And if you look at housing pricing, and this is data we're going to get next week, we can already see that you have a depreciation in terms of the house development or house price development. Obviously, that would lead the shelter component, which was the component that surprised 0.1 above the consensus and was the factor of the little bit higher CPI print than we thought last reading. But obviously this will roll over. And if you make a thought experiment to, rather than doing the shelter component of CPI and replace this by the actual rental that we're paying in the economy, you can see that core CPI would have moved much higher, a lot quicker, or with the same speed, but the same timing, but a lot higher, but then now becoming in a lot lower. And this is sort of an oil tanker. We know this would affect the CPI prints in the second half of the year. So this trajectory in our arithmetic, also on the base effects, it's unstoppable as things are looking right now. Through in supply bottlenecks that are now arguing for deflationary price pressure. Through in various variables to look at inflation, you can clearly see the peak of March 2022. But you can also see that we are moving away from reds, pinkish, and then into the outright blues, i.e. you are starting to see deflation popping up or disinflation popping up all over the place. And this trend is obviously being maintained by the fact that this blue line is working on the downside, which is a trimmed mean, i.e. take away the whiskers of the distribution, so we get rid of the craziness, both on the upside and downside. I get rid of shelter to some extent, and you can see that the core or the main basket of price pressure is actually rolling down quite rapidly, which of course will be proven right with some time effect, which we always have between the median and the trimmed mean. And obviously, as I mentioned before, China is exporting deflation to the US. So it's quite interesting. Not the US will end up in a deflation because of this, but it will end up in disinflation. That's the main point. So nothing here has really changed, which is quite important. Yes, wage pressure is rolling over. Yes, pricing plans are rolling over. Yes, consumer expectations for inflation has rolled over and coming quite low. So this is all the same. So this is why I think one should also take a view on the latest market moves in Fed and Fed funds with a not a grain of salt, but absolutely 100% serious. But also try to use that more than just lean back and be afraid of it, and see how can you work with it constructively. One way to try to work with this constructively is to look at if we know there's a relationship between inflation, Fed rates, and the equity market. Why don't we shortcut the whole thing and say there's a relationship between inflation and the equity market? And why don't we look at this latest move upwards in rates as an opportunity to buy into a segment that we think is going to be proven right when and if inflation will confirm what we had traded in back in January. I.e., it's like you get a second chance to add to growth. I.e., you get a second chance of doing the October trade all over again. This is where I look at the priced inflation, which is inverted. So you have hikes, and the light gray here is artificial intelligence companies in the US selling off. And then you have the pivot in October. The pricing changes direction in the US and moves into cuts. And you have a lagged effect on AI. So you saw a move in January, and then it moves back a bit, and that's bang where we buy it again. And one of the reasons is that you can see inflation here being inverted, and you can see you peaked back in June, July, and then you can throw in different monthly rates of change for inflation and model and see what does that mean for the equity strategy. Well, if the inflation moves by 0.4% each month on month for the remainder of the year, we should break even on the strategy. It won't be that kind to us, I think. We probably have to take it off before that. But it's quite interesting to see that with a number of scenarios on a month-on-month move upwards in inflation, downwards in inflation, it's inverted in the graph, you can actually make some sizable gains in this strategy. And if you look at the bottom right graph, you can simplify this and say, well, let's just look at it, the expected change in inflation rates next year. And you can see that it's going to move lower because, again, the peak, and then you have the pivot, and then it's going to move lower. And that's a quite nice, almost monthly, perfect correlation with the strategy. So obviously, it's a way of illustrating if you want to take a view that the Fed fund futures has to reverse direction, and we sort of max the pricing for the time being. This could be a neat way to make a good return. Obviously, I'm biased because this is what we've done in our books, but it also fits well into our long-term view that as soon as we get pricing going against our house view, which you could argue that the last weeks pricing in terms of Fed funds has done, we have to make a change of either we change the house view and say, well, inflation is going to turn around and move up again, or something else, or we take the position and move against it. And that's our job, to take the position. So the Fed outlook, obviously we don't have to go through the history that we always knew that we're going to end up with cuts even before we start hiking, and then yes, we're going to hike a bit more than we thought, and then we're going to cut, and then we're actually going to hike again in 2026, so we all look forward to that. But I think it's going to be a while until we start to price that. If you look at the language that Fed is using, they were well aware of that they're now moving in dovish. The peak hawkishness was in June 2022 in terms of natural language programming, in terms of their own language in minutes. And since then, and the last meetings were quite actually more dovish. I know this is not the general description in media, but that's the math of the language that the Fed themselves are using and publishing. So it's quite interesting to see the relationship between the language put into numbers and the 10-year yield. And this move up is something that we have decided to fade, basically. Again, using the artificial intelligence, which obviously also gains from the industry news in terms of AI now being able to not only learn and listen to people, but also actually make code, which is a big game changer for artificial intelligence. That means that the likelihood for a 50 basis points hike in March, which has increased from being virtually zero to some 20%, has of course thrown in a sort of a wrench in our equity wheel. But it's very interesting now to think about this. Is this another September we're going to see? September equity sentiment plummeted. And you can see that you were hiking quite aggressive pricing on the Fed, and then everything turned. And we think we're actually going to repeat that October trade again. And I think the market thinks that as well, because the sentiment hasn't budged. So we're not alone in this. This is sort of the consensus amongst equity market, actual investors. We're not turning bearish on this. I think people are exploiting this to take new positions. And there might well be not only market players in terms of options, but also retail that are making some shifts in the equity market, which you can see in data. That also means that we're now tracking this graph. This is the Fed Fund Futures curve from 4 weeks ago, 3 weeks ago, 1 week ago, and today. And obviously we are looking now for the moment when this turns lower again, and that will be a great signal to look over the positions yet again. And that's what we have to front run. That's what we've done with this trade. We can't wait for it to happen because the repricing could be quite aggressive. That means that we are obviously wrong in the sense that we bought the US Treasuries at 4.2. Now we sort of moved with us, against us, with us, against us, but the model has always been the same. Both models have always been the same. Yields will turn lower, and that's still our forecast. Now yields, we can go into this idea of the US curve, because I think that's quite interesting. And I'm going to spend a few graphs now just discussing the curve, because obviously the pink bands here are where the curve inverts, and this time in the 1960s it did not lead to recession. Then it did in the 70s, and then you had a recession almost without any curve inverting, which was quite common. This going back to 1920s. And obviously now the curve is inverted. So what does that mean? Well, not too much, I think. That was an executive summary of the whole thing. Because first of all, the inversion of the curve, which I'm showing here, 2 tenths and 3 months tenths, is something has to be dealt with a bit careful in terms of the actual timing to a recession. We know statistically that yes, if anything, if you are to have a recession, it will come between 330 to 600 days after the inversion. So great, because we know the economic cycle is 5 to 7 years, and we have up to 600 trading days, which means that you're 100% guaranteed to be right if the curve inverts and you shout recession. But you're absolutely pointless in the market. How are you going to trade that? This is the current inversion versus the S&P 500, and I tried to mathematically make an optimum fit, and you can see that it's iffy at best, very iffy at best. So that means that we need to raise the bar on how we look at the curve. So we can calculate how many points on the curve are inverted. 1 2s, 1 3s, 1 4s, 2 3s, 2 4s, 2. I mean, almost like bootstrapping. Well, not really, but you know what I'm saying. So you have about 90% of the US curve being inverted. How does that correspond to the equity market? And you have an equity market in logarithmic scales. And you can see that sometimes it doesn't mean anything. It means the equity market should go up, the equity market should go down after a couple of years. The correlation with 100 trading days is actually mean reverting to 0. So the statistical relationship here is not like it's strong enough to be 0.1 or 0.2. It's actually 0.00. If you look at the momentum of the percentage of the curve being inverted, so we add another layer on the analysis, you can see that again, the mean since 1960s is slightly negative. Right now you see curve inversion and equity market moving up, so you have a positive correlation. That was not supposed to be the case. The case is supposed to be the other way around. There are other ways around that are occurring, but you can also see that in times of recessions, the correlation is not even stable. It shifts and moves back and forth. So I would argue that the curve is interesting. We keep an eye on it. But it could actually be that it's not the curve itself that is important. It could be models anticipating the curve. And here you have New York Fed's recession monitor building on the US rate curve, and you have a leading indicator, and that's moved around. Is that indicator and those variables what actually is driving the equity market? I would argue yes. Then you actually can get some traction. Threw in another bone in the concept, and that's what Powell says. You have to look at the short money market rate spreads, and they are not inverted. It was a dip lower back in December, you know, the week there before Christmas. But these two curves are not inverted at all. So that's pretty interesting. So it sort of makes you think, what is that signal worth really, rather than enormous amount of discussion times in terms of media and I don't know how many trees we need to chop down to print all that useless analysis. We think it's, I shouldn't say useless, we think it's important to keep a traction or keep a track on it. But it's very difficult to take a position on it. Yes, you can sit on one side of the fence and say there will be a recession, and this is what I look at. But the same person can sit on that side of the fence and say yes, there will be a recession because the sun went up today. It's pretty much useless, I think. But still, we keep track on it, we keep analyzing, we keep following the correlations because we don't want to miss this if it bites. That means that this rate move up that we see doesn't mean anything for financial conditions. Financial conditions have been very tight for a long period of time, don't forget that. So now that we see the financial conditions moving lower, it's of course very welcomed by the equity market. Again, the peak, the pivot, October 2022. The rate move up, now we see now, not enough really to change anything. If anything, it actually means further easing of the financial conditions. You can actually see that the market takes this with a stride. Compared to the September-October event last year, we can see tremendously sharper, lower move in financial conditions, which is obviously a great positive for the equity market, and also why I think equity sentiment is quite stable. Growth outlook, rebounding in the US, recession risk moving lower. We're actually going to break below 15% pretty soon. Yes, we know we're going to have a slowdown. A soft slowdown has been our forecast all along. If anything, recession risk is moved a bit into 2024. But then again, the recession risk that we're talking about here is a 20% recession risk, nothing more than that. The Fed's own model is at 22%, which is quite notable. And if anything, if you look at global growth indicators, you're back to a very strong growth. Does it feel like that? I'm not too sure. If you ask people on the street or people in the market, do you recognize and feel that you're in a rebounding economy? I think the still answer will be a lot of concern, a lot of nervousness. But it's important here to remember that this drives allocations. And that's what drives the equity market. Here you have the Fed funds inverted, the New York Fed recession probability inverted, and here you have OECD indicator, showing rebounds on both ends, which is obviously quite positive. And again, Germany being forefront of the rebounding economies together with China, for example, and the US. And the whole world is being revised up, as you can see revisions, and this is the final GDP print for this year according to IMF. And the whole world was revised up by 0.3% in the last forecast. Quite interesting. There could be potential now to start bargaining hunting on this end, but that's something we come back to. We can skip that part. In terms of the GDP indicators that are very short term for the US, moving up. In Sweden, OECD moving up. The local SCB, Statistical Central Bureau, is moving down. You have a huge spread. Luckily, the equity market listens most to the OECD. But this number will be updated this coming week, and it will be very interesting to see if it's revised upwards. If anything, that could mean potentially a bit more hawkishness, i.e. we have moved lower on our dollar exposure. We're going to move lower as we speak, and again actually diversify also away a bit from euro to other G10 currencies. So we try to anticipate that one as well. In terms of macro data for the next couple of weeks, obviously I've spoken about a number of these, like CPI, PPI in the US, China, GDP indicator in Sweden, house price in the US. But a quick look at the outlook for next 2 weeks, remember that economic momentum right now is positive, positive surprises in Sweden and US and Europe. We believe that non-farm payrolls will come in a bit lower than everybody else thinks. Not everybody else, but we have 150,000 in our print. We believe that unemployment rate will move up. We believe the ISM will move up both based on regional service and also if you look at actual volume being transported on railroads, ports, motor highways and waterways. And German production will move up a tad as well. So this still means, you know, this solid economic expansion or rebound that we thought were going to happen in 2023 is still in the cards. We think that's great. We're still in a soft landing in the US. We still have a lot more job openings than we have job applications. So obviously this could be, this is probably the definition of a soft landing, you know, as far as we can tell right now. Unemployment rate, you know, very low. It doesn't speak any concern about a recession as we're speaking. You're going to have retail sales in Sweden. Real wages obviously be very depressed. Speaking of lower, very soft retail sales, you have credit card expenditures. I wouldn't say that retail sales should fly up to this level because obviously credit cards could also be used due to the credit side of things. So it's a bit iffy, but we keep in our equity weights to Sweden and Nordics, but also exposure on manufacturing side. And this is our leading indicator for Swedish equities, so it hasn't changed. So in terms of equity outlook, we still see you know better financial situation in China in terms of liquidity. We can see that the high frequency economic models for China is really leapfrogging on the upside, which is why we think it's worth to keep a little stick left in the Chinese equity market, which we have. And notably, we haven't for almost a year seen this much institutional buying. If we measure this through our daily range indicator, which sort of leads the equity market with a few days, we can see that margin depth momentum is moving back. And if it breaks zero, that will be a rally on the equity market. What we've seen so far is just the second derivative turning back, which is good enough, so to speak. The equity sentiment, not at all comparable to what we saw in September. Very important for the equity market, given the pricing of the Fed. So we are reasoning, probably as a lot of other people are, that we want to fade this to begin with at least and see where it takes us. First that should happen is that the Fed fund futures repricing should threaten financial conditions and our daily range indicator or daily trading indicator, which it hasn't. Overall global risk for the equity market, looking at rate spreads, CDSs and FX and fixed income vol are still very positive. Fear and greed are still very positive. If you look at where we should feel the pain, which we saw in September, i.e. counterparty risk dollar liquidity vol, you can actually see that it's moving the other way around, even though we're moving up in terms of what we think is going to be a Fed policy rate, i.e. we decide to fade this move and do reallocations and increase the bets that if anything this will turn around. Because we are an active asset manager in that sense. Flows still positive to the equity market, obviously being driven by institutions that are pushing up the equity weights in their portfolios to an extent that we haven't seen since 2021. Obviously, retails are lagging, which is quite normal after this kind of shock and horror we've seen that reminds of 11 or 15, 16 or even 08, 09. Options aren't threatening the picture as we're speaking, which is quite good compared to what we saw in the Christmas week. So that's always obviously positive. The whole Huber liquidity ratio is something I think is going to be more and more important and do some more modeling on. Obviously, what this means when it goes on the upside is that the market is more prone to buy and hunt the upside than they are concerned about selling off and protecting from the downside. It's vice versa from what we saw in 2021 going to 2022. So all of 2022, the market has been more concerned about the rebound, which is probably why once it happens, it's quite rapid as we've seen the last couple of months. We know that allocations will move back to the equity market. Now, it's quite interesting that earnings revisions have troughed and start to move on the upside, which is quite interesting. That's one of our predictions for 2023. Knock on wood, luckily, we've been proven right so far and been rewarded in the equity market. The blue here is a country that was quite late to the earnings revisions, collapse, and then starts to rebound. That is quite interesting to take a position on, and I call this country next trade because we don't want to write what is, we can't write what it is, but we'll be back in the next time and explain what country it is that we're actually taking the position on. The pricing target estimation is also moving on the upside for this very specific country. That earnings revisions are moving up is not at all surprising, given the high correlation earnings revisions have to macro revisions, macro surprise data. We know that profit cycle has turned up by looking at national accounting. We do not look at earnings 12-month forward EPSs because they are lagging the actual equity market. So the turnaround is still visible in EPS forecasts. I know there are a lot of EPS forecasts, there's a lot of profit talk out there. I think one has to really be very accurate in terms of what profit measurements am I looking at. How do I model it to make sense of my portfolio, rather than just listening to EPS, the annual growth of EPSs are moving a tad to the negative side. Absolutely true. If that has been priced, what's the point? And I think this is the distinction I would argue we need to sort of crack. And for us, the fact that earnings revisions have troughed and price targets, and this is the EPS forecast you can see on the light blue, that for us is a lot more important than backwards looking so-called 12-month forward EPSs. Should probably be called 12-month lagging EPSs or something. But that said, I think that's something we decide to be quite careful on. This all happens in a context where the global credit impulse indicator is not blowing up, but it's expanding rapidly, beautifully. If you compare to what we saw at the end of the year 2021 going to 2022, it's something completely different. And obviously Centix is following. Centix is a combination of sentiment and flows. So it's not enough to say you're bullish, it's actually how much money you put behind your words. A great measurement. And I think this is quite interesting to see where we're going to end up in terms of global credit and Centix indicator. Now that said, we will be back in 2 weeks' time. So far, given the fact that the growth outlook is improving, earnings revisions is improving, price targets improving, the equity sentiment is stable, our daily trade indicators are stable and positive, and the inflation outlook is unchanged. We see this last repricing of the Fed fund futures and the effect it has had on the equity market as a time for reallocating and doing a bit more spear-pointed risk on where we see the most downbeat sectors, like tech being one of them, and just try to play that we're going to do October 2022 all over again. Right or wrong, we will be back in 2 weeks' time and take measurement of that, but that's our view for the time being. So I thank you so much for your time, and we'll be back in 2 weeks' time.